Hello, this is Tim Congdon, Chair of the Institute of International Monetary Research at the University of Buckingham. This is the monthly video on monetary trends around the world that I give. Sometimes I look at lots of countries, sometimes I only look at one. And on this occasion, I want to focus on my own country, which is Britain. It's June 2022. And we've just had some pretty awful inflation numbers. The increase in the consumer price index in the year to April was 9%. Increase in the retail price index, which used to be the one that we followed in Britain, that was actually in double digits. And these numbers are far ahead of what the Bank of England is supposed to deliver. The Bank of England was given its operational independence in 1997, 25 years ago, in the clear understanding that its job was to keep inflation on target, which became a 2% increase in a year on the consumer price index from 2003. And we in fact have a number that is 5 times that, more or less. We haven't quite got to 10%. On the consumer price index, but we're quite likely to. Now, the Governor of the Bank of England, Andrew Bailey, gave some evidence to the Treasury Committee of the House of Commons on the 16th of May. The point of the legislation in 1997 was to allocate responsibility for keeping inflation down. So if things go wrong, then surely the Bank of England is to blame. Well, no, that's not what Mr. Bailey said. He said that he and his colleagues had been buffeted around by a number of shocks, Boston prices from around the world that were unprecedented. And he cited the increase in energy prices. He said there was an apocalyptic increase in food prices tied up to some extent the events in Ukraine. He said that there are lingering effects of COVID on the ability of the economy to produce goods and services, and so on. Just a sequence of shocks. And over and above that, he split out the relative size of these influences on the consumer price index as he and his researchers saw the matter. He said that 20% of the current inflation rate was due to homegrown domestic influences, and 80% due to global developments over which the Bank of England had no control. Now, I don't agree with all this, and I want just to say, as it were, to sharpen up the debate, that over a year ago, I was on a committee, the so-called Shadow Monetary Policy Committee, not the true Monetary Policy Committee at the Bank of England, Shadow Monetary Policy Committee, which is a group of economists that meets every now and again under the aegis of the Institute of Economic Affairs, a think tank in London. And we had various discussions in February, March, April 2021, over a year ago, about the rather high rate of monetary growth that was then being recorded, and we were worried about inflation. And we put our fears and worries into a letter to the Financial Times. This is all a matter of public record. And I want to quote from this letter that appeared under the Shadow Monetary Policy Committee's name on 26th of April last year. We believe that above target inflation is to be expected in 2022 and perhaps 2023. In our view, the Bank of England will be to blame for this setback. That was said over a year ago. As it took the measures that have pushed money growth to its current excessive level. We fear that inflation above 5% is likely at some point in the next few years, and we particularly attacked the Bank of England's decision to have another round of quantitative easing announced in November 2020 of about £150 billion. Here is the chart of money growth in the UK going back to 1964. This is broad money, all money balances. You can see how the highest rates of money growth were in the 1970s, 1980s, which were indeed very inflationary. In the period since then, the last 30 years, typically money growth has been lower, one or two ups and downs, but typically lower. Inflation's been typically more or less on target, one has to say. But then notice at the very end that move up to 15% is the highest figure since the late 1980s. That money growth development was what worried the Shadow Monetary Policy Committee. And I'm sorry, Mr. Bailey, you were right, and you didn't notice that, and you got it wrong. There was another aspect of this I think is worth noting, that you can split out the money holdings from that total of households, companies, financial institutions, and start saying some things about the behavior of asset prices, about the behavior of companies, and so on. And one of the points that the Shadow Monetary Policy Committee highlighted was that there'd been a very sharp increase in money held by companies. Companies are big employers, companies are the people who decide about levels of production. They have a huge influence on the economy. So one of these money series shows that companies' money holdings in the year to February 2021 was no less than 29.2%. Numbers as high as this have previously been recorded only in the inflation of the 1970s, 1980s. The last time an annual growth rate of company money reached 30% was in late 1986, ahead of the boom years 1987 and 1988, which also led to inflation, high inflation. So this shows you that growth rate of company money holdings back to 1964. So there's extremely high numbers sometimes in the 70s and 80s, then lower numbers in the last 30 years, except that in early 2021, we again had a number like 30%, giving a very clear warning that something was going wrong. Now, the reason that that's interesting is companies, of course, make decisions on production, they make decisions on employment, they make decisions on the size of the stocks of finished goods and raw materials they're going to hold. So their behavior, their decisions are crucial to the economy. And if you see this sort of rate of money growth, you should expect rather boomy conditions. And so we economists outside the Bank of England, more than a year ago, using money supply data, were able to predict inflation of above 5%, and already at that stage say the Bank of England had blundered. Well, let's try and then think a little bit more about what Andrew Bailey has been saying. I would say that there are three main mistakes in the remarks that he made to the Treasury Committee. The first one is that it's always a mistake, in my view, to attribute the movement in an aggregate price index entirely to the behavior of its components. It isn't really a causal analysis. It's always the case, it must be the case, that the increase in an index is the result of an increase in all the components of the index, and to highlight one or two of them is actually to confuse symptoms with causes. I mean, if it really were the case that you could explain total inflation by this, you're simply saying that inflation is total inflation as a result of a number of price increases. That's not very helpful. Obviously it is. That's how it's defined. If it really were true that these were shocks that were going to disappear in the fullness of time, in other words, if there's this 10%, which 80% is due to external forces, are they going to disappear at some future date? Should we be expecting a negative impact on the price index of minus 6, 7, 8% coming through in 2023 and 2024. The real meaning of these kind of assertions is that the Bank of England can't control inflation at all. I mean, if these really were temporary shocks that are going to go away, the 9-10% we have now should be offset to reach the average of 2% by numbers of -6, -5 in the future. Is that what Andrew Bailey is suggesting? Of course not. They will regard themselves as having fulfilled their remit. If inflation comes back to 2%, then what is so special about these particular shocks in this particular year? The second problem here is that Bailey talks about 80% from the outside world affecting the UK. Please, we are only one country. All the world's nations are affected by this supposed 80% of influences of various kinds, oil prices, wheat prices, all the rest of it. And I don't deny that there are these influences. But if every country had the same influence in this way, they should all have the same inflation rate. And they don't have the same inflation rate. Rather obviously, a place like Venezuela with hyperinflation, a place like Argentina with inflation of 40-50%. Places like America, at the moment inflation rate also about double digits. And then there's Switzerland with inflation of 2.5%. And Japan with inflation of 2.5%. How? How is that magic possible? The answer is the behavior of the quantity of money. You can see this clearly enough, I think, in this chart. In this table, the growth rate of money in Switzerland in the 3 years, the end of 2021, was 9%, whereas in the USA it was about 45%. And it's that difference that explains the difference in inflation rates. The final point I want to make is that these inflation processes, we've been through a number of these cycles in the last 50 years, and indeed, in a sense, going back to the start of the Industrial Revolution. They tend to have a common pattern, which is that there's an upturn in money growth that boosts asset prices first, that then stimulates demand and output. There's overheating, and of course there are supply side shortages. That's always found in these cycles. That then affects inflation not just in asset markets, but inflation in goods and services, and that's what's happening in 2022 after the buoyant asset markets in late 2020 and 2021. Now look, you can't explain the movements in the stock market, the movements in house prices, movements in, say, the prices of the works of art, whatever, these all things all related. You can't explain these by energy prices, wheat prices, apocalyptic developments in the Ukraine and so on. You cannot do that. Plainly not. Let's just look at what happened to house prices in the UK in the last few years. Logically, you would expect that COVID, surely bad for the economy, therefore should be bad for house prices, logically. You'd therefore expect, if that were the only influence at work, that there would be less house price inflation in the 2 years after the March 2020, when the COVID emergency really began. There should be less house price inflation 2 years after that than in the 2 years before. Well, here's a chart which shows what actually happened. And you can see that almost from the very beginning of the COVID period, house price inflation in the UK accelerated. Very strange, isn't it? Why? Well, the answer is, I suggest, that that was when the rate of growth of money started to accelerate as the Bank of England took these extraordinarily stimulatory measures with its purchases of gilts, some corporate bonds and so on, in the spring of 2020. Similar kind of developments in the United States, somewhat smaller scale relative to the economy, still very, very stimulatory measures which led to very marked acceleration in the rate of money growth. What we had in the 2 years to the first quarter of 2022 was an increase in house prices for getting on for 20%, whereas the increase in the 2 years before COVID was 3%. Now, Mr. Bailey, you can't possibly explain this by all your references to energy prices, wheat prices, and all the rest of it. It's just nonsense. And this is very typical kind of, these sort of cycles have been through many times in the past. I've talked about them on many occasions in my career. And it is, as I say, plainly ridiculous to say that unprecedented supply-side shocks were to blame for the house price inflation that Britain has seen in the last 2 years. Well, let's try and allocate blame for all this. As I said, it's very much the blame of the Bank of England, as similar inflation problems in the USA and the Eurozone. And again, the central banks are to blame, the Federal Reserve and the European Central Bank. There isn't really much by way of mitigation one can say about this, because there's no doubt that these institutions were told to keep inflation under control, and they got distracted by all sorts of things. They're supposed to deal with climate change and digital currencies, all sorts of nonsense. The fact of the matter is that they allowed the growth of money to accelerate far too rapidly in 2020, to some extent in 2021, and we are now coping with the inevitable inflation that's followed the upturn in money growth. I would just say, to some extent, in extenuation, that what central bankers do, reflects a climate of opinion, reflects the attitudes of economists in general. And it is true that in spring of 2020, what the central banks were doing, with, by the way, finance ministries in most countries, was very much to applaud the measures that were being taken. I mean, in the UK, the Treasury and the Bank of England were working together in that period, without much doubt. And I'd like just to on this front, just to quote from something that was said by Gavin Davis in an article in the Financial Times in June 2020. He said that there's this big jump in public debt because of the so-called expansionary fiscal policy that the governments were up to. Then the Bank of England helped finance that deficit, similar developments in the USA and elsewhere. According to Mr. Davis, the increase in debt should be seen as a shock absorber, and the overall assessment from, in his view, the profession was a chorus of approval. That means the economics profession. Well, I didn't agree with that at the time, and I certainly don't now. Yes, the Bank of England is to blame above all for this inflation rate 5 times the target, but we also need to think about what's gone wrong in the economics profession. Thank you.